Welcome back to the Crypto Chronicles, where we like to really dig deep into the world of digital currencies.
That's right. We're all about going beyond those flashy headlines.
Getting to the heart of what's really driving these digital assets.
And for today's deep dive,
We're focusing on the big daddy of them all, Bitcoin.
Bitcoin, exactly.
And its mysterious origin.
To its growing role in the wider financial system.
It's been quite a journey.
It really has.
So we've gathered a bunch of really interesting research to help us understand how Bitcoin has evolved.
We're going to look at how Bitcoin's price has moved with the stock market.
Unpack the whole mining process.
And delve into why those big institutional players are getting so interested.
For you listening, we're going to try to paint a clear picture of how Bitcoin has gone from being this fringe tech thing
to something that's becoming more and more a part of mainstream finance.
So let's jump right in.
Sounds good.
One of the most interesting things that came up in the research was this growing connection between Bitcoin and traditional financial markets.
Oh, yeah, definitely.
Especially those big U.S. stock indexes like the NASDAQ 100 and the S&P 500. It doesn't seem to be acting as independently as some of us might have thought, right?
You're absolutely right. The data from 2018 to 2025 shows a clear shift.
Interesting.
The studies we looked at used some pretty advanced methods to analyze the data.
Okay.
Things like rolling window correlation.
Wow.
Static correlation coefficient.
Okay, so fancy statistical stuff.
Yeah, but they all consistently showed that the correlation jumped significantly after big moments of institutional adoption.
Like what? Give us some specific examples for the listener.
Well, the introduction of Bitcoin ETFs, for instance.
Right.
And remember when companies started holding a ton of Bitcoin on their balance sheets, like MicroStrategy? When companies like that got included in those big indexes, like the NASDAQ 100, it had a huge impact.
Interesting.
The research showed that the correlation peaked as high as 0.87 in 2024.
0.87, that's pretty high, isn't it?
Yeah, it is. Imagine a perfect correlation of 1.0 as two dancers moving in perfect sync.
Okay.
0.87 is pretty darn close.
So Bitcoin and those stock indexes were pretty much doing the same dance during that time.
Exactly.
So for our listeners out there, what does a correlation that high actually mean for their investments?
Well, if you're thinking about diversifying your portfolio, a high correlation like that means Bitcoin is likely to move in the same direction as those equity markets.
Oh, I see.
So if the stock market goes up, Bitcoin probably will too.
And if it goes down?
Bitcoin will probably follow.
So it's not doing a great job of spreading risk when the correlation is that high?
Not really, no.
So this idea of Bitcoin being this totally separate thing, a safe haven when the traditional markets get rocky,
right.
That's not so clear-cut anymore, is it?
Not really. And what's even more interesting is that these correlation trends aren't fixed.
Oh, yeah.
They actually change depending on how the overall market is feeling.
Interesting.
They get stronger during what they call risk-on periods.
Risk-on, meaning?
When investors are feeling optimistic and more willing to take risks.
Okay.
But the correlation weakens when it's a risk-off period.
So when things are a bit uncertain and people are moving towards safer assets?
Exactly.
Makes sense.
The research showed this happening with big events like the COVID-19 pandemic.
Right.
There was an initial dip in the correlation.
Right.
But then a surge during all that money printing and stimulus.
Right. And then up and down as central banks started tightening their policies.
That's right.
It seems like this increasing involvement from big institutions is a major factor in all of this.
Oh, yeah, absolutely.
The more they get involved, the more Bitcoin seems tied to the rest of the market.
That's one of the key takeaways from the research. Things like Bitcoin ETFs have basically made it super easy for traditional investors to get into Bitcoin.
Right, without having to deal with the hassle of actually holding the digital asset themselves.
Exactly. So that naturally leads to more interconnectedness with the established markets.
Makes sense.
And you've got examples like MicroStrategy, with all that Bitcoin on their balance sheet being part of the NASDAQ 100.
So that's not just about the company's own success anymore. It actually affects how Bitcoin relates to the whole stock market.
Exactly. It basically injects Bitcoin's volatility right into the equity index.
Right. So when Bitcoin's price jumps around, MicroStrategy stock probably does too.
And that affects the NASDAQ 100, strengthening the link between the index and Bitcoin.
It's all connected.
It is.
Okay, let's shift gears a bit and talk about how new Bitcoin is created.
Okay.
This whole mining thing.
Mining, yes.
Our sources really dug into the process and the role of Bitcoin scarcity.
Right.
It's not like a central bank just printing more whenever they feel like it, right?
Definitely not. Bitcoin is created through a specific process called mining,
Mm-hmm.
and it's all based on this system called proof of work.
Proof of work, meaning
Basically, it's like a digital puzzle race.
a puzzle race.
Yeah. Powerful computers compete to solve complex math problems. Okay.
The first miner to solve the puzzle gets to add a block of transactions to the blockchain.
The blockchain, that's that public record of every Bitcoin transaction, right?
That's one. And they get rewarded with newly minted Bitcoin.
So that's how new Bitcoin is created.
Yep.
But these puzzles, they're intentionally difficult, aren't they?
Oh, yeah, definitely. You can't just solve them on your home computer.
Okay.
The Bitcoin system automatically adjusts how hard the math problems are every 2 weeks or so.
And why is that?
It's to keep the rate of new blocks being added to the blockchain pretty consistent.
Consistent. How?
They aim for about one new block every 10 minutes.
Interesting.
So even if more miners join in with more powerful equipment, the rate at which new Bitcoin comes out stays pretty stable.
I see. So it's all very controlled.
It is.
And this brings us to the whole idea of halving.
Yes, halving.
What's the big deal about these halvings and Bitcoin's scarcity?
Well, the Bitcoin halving is a pre-programmed event that happens roughly every 4 years.
4 years. Or after every 210,000 blocks are mined, whichever comes first.
Okay.
When a halving happens, the reward that miners get for adding a new block is cut in half.
Cut in half, so.
This is absolutely key to Bitcoin's design.
In what way?
It's designed to be deflationary.
Meaning?
Its total supply is capped at 21 million coins.
Oh, right. I've heard about that.
So the rate at which new Bitcoin is created keeps getting smaller over time.
Okay, so walk us through that. What was it like in the beginning?
Sure. Back in 2009, the reward was 50 Bitcoin per block.
50 Bitcoin.
Wow. Then after the first halving in 2012, it dropped to 25,
Okay.
then to 12.5 in 2016, 6.25 in 2020.
So it keeps getting cut in half.
Exactly. And most recently, in April 2024, it was halved again to 3.125 Bitcoin per block.
So what happens eventually?
This halving will keep happening until we hit that total supply of 21 million Bitcoin.
And when's that supposed to be?
Sometime around the year 2140.
Wow, that's pretty far out.
It is.
So the idea is that this increasing scarcity, it should push demand up, and therefore the price too, right?
That's the basic economic argument, assuming all other factors stay the same, of course.
Okay.
By reducing the rate at which new Bitcoin comes into the market, Bitcoin's scarcity naturally increases over time.
Right.
And that limited supply, it's hard-coded into Bitcoin's DNA, so to speak.
I see.
It's a key part of why people see it as valuable.
People often compare it to gold, right?
Exactly. And the anticipation around these halving events, it creates a lot of buzz and speculation in the market.
But our sources also mentioned how these halvings affect the miners themselves.
Oh, yeah, for sure.
If their rewards keep getting cut in half,
Right.
how do they stay motivated to keep the network running?
That's the key question. As the block reward keeps shrinking, transaction fees become a lot more important for miners.
Transaction fees, you mean?
Yeah, when you send Bitcoin, you can choose to pay a small fee
Right.
to make sure your transaction is included in the next block. So as Bitcoin gets more popular and the number of transactions goes up, those fees could really add up.
Interesting.
Potentially enough to make up for the smaller block reward.
So the future of the Bitcoin network, its security and all that,
Mm-hmm.
it might depend more on people paying those transaction fees than on the reward of new Bitcoin.
That's the expected evolution.
That's pretty fascinating.
Plus, mining hardware keeps getting more efficient.
Right.
And miners are looking for places with cheaper energy, including renewable sources, to stay profitable.
Makes sense.
And of course, the price of Bitcoin itself matters a lot. If the price goes up, it helps miners deal with those reduced rewards.
Right. So it's all this complex interplay of incentives, technology, and market forces.
Absolutely.
Okay, let's get back to the whole institutional adoption thing.
Okay.
It's clearly not just about ETFs anymore. Our sources point to a much broader trend of traditional finance embracing Bitcoin.
Yeah, absolutely. The launch of those Bitcoin ETFs in the US back in 2024 was a big moment.
It was.
It gave both institutional and everyday investors a simpler and more regulated way to get exposure to Bitcoin.
Right.
But we're also seeing big players like BlackRock and Fidelity getting involved,
Really?
offering Bitcoin-related services, looking into tokenized funds and blockchain solutions.
Yeah.
It's pretty amazing.
So it's not just about ETFs anymore. It's about how Bitcoin is changing the whole financial landscape.
It really is.
One of our sources even argued that this doesn't necessarily mean Bitcoin is losing its decentralized nature.
It's an interesting point.
What's the argument there?
They're saying that these traditional players are adapting to Bitcoin's growing mainstream acceptance.
Rather than trying to take control of it.
Exactly.
Right.
Bitcoin offers something unique.
Like what?
It's like digital gold, outside of government control.
Right.
That's something traditional banking systems just can't replicate.
Interesting.
So by offering things like Bitcoin ETFs, these firms are responding to growing demand from investors.
Investors who might find it difficult to buy and hold Bitcoin directly.
Exactly.
So it's like traditional finance is acknowledging that Bitcoin is here to stay,
It seems that way.
and they're figuring out how to fit it into the existing financial system.
That's a good way to put it.
We're even seeing things like PayPal launching their own stablecoin
Right.
and MasterCard testing blockchain technology for cross-border payments.
And central banks around the world are exploring their own digital currencies.
So it's not just Bitcoin.
No, it's much bigger than that.
It's about recognizing the power of blockchain and the potential of digital assets.
Absolutely.
So, for you listening, what does all of this mean? Bitcoin's journey from this niche digital experiment to a more integral part of the financial world has some pretty significant implications.
It really does.
Its increasing correlation with traditional markets suggests that it might not be that completely independent safe haven it once seemed.
At least not consistently.
Right.
And those halving events, they're still shaping how much Bitcoin is available.
And influencing how the market feels about it.
Exactly.
And the fact that big institutions are getting more involved, it signals a potential shift in how Bitcoin is perceived and used in the coming years.
It does raise some important questions.
Like what?
About Bitcoin's long-term role in investment portfolios and the potential risks that might come from its deeper integration with the traditional financial system.
So for those managing investments,
It means they need to keep reevaluating their asset allocation strategies and how they manage risk.
and for policymakers,
They need to understand these changing dynamics.
so they can create regulations that protect financial stability.
Exactly.
And we can't forget about mining.
Right.
As rewards for mining decrease, the security of the network might depend more on transaction fees.
Which could mean that only high-value transactions make sense economically.
That's a big shift from the early days of Bitcoin, when the idea was low-cost transfers.
Right is.
This has been a really fascinating deep dive into the forces shaping Bitcoin's evolution.
It really has.
It's clear that its story is still unfolding.
And the interaction between its unique characteristics and the established financial system, it's going to continue in ways we can't predict.
Right. And further research will be crucial to really understand the long-term impact of all of this.
Absolutely. We need to understand how regulatory changes, global market integration, and the evolution of mining incentives will affect Bitcoin's trajectory.
And that brings us to the end of our deep dive into Bitcoin's journey.
It's been great discussion.
Given Bitcoin's increasing correlation with traditional markets and how those mining incentives are evolving,
Right.
what could be the next big turning point in its integration into the global financial system?
It's something to think about.
We encourage you to keep exploring these complex topics, consider different viewpoints, and think critically about the world of digital currencies.
It's constantly evolving.
Thanks for joining us on the Crypto Chronicles.
See you next time.